If you have ever borrowed money to buy a home, then you're probably aware of the 30-year and the 15-year fixed-rate loans. But did you know there's a 40-year loan? When it comes time to borrow money for the purpose of buying or refinancing a home, borrowers today have numerous options. While you do not have a lot of control over the mortgage interest rate that you'll be charged, you do have the benefit of multiple choices on the amount of time you take to repay the loan. Today, we're going to examine 3 different repayment periods, including a 40-year amortized loan, to see how the time you choose to satisfy the loan impacts the benefits you receive. When you borrow money from most banks or mortgage lenders, they provide you with a principal and interest payment that you agree to make each month for agreed upon period of time. This amortization of the loan ensures that they get the interest that you agree to pay for the entire period of time that your loan has an outstanding balance, while you get a payment that does not change during the entire payback period of the loan. For most of my career, lenders typically offered a 15-year amortization and a 30-year amortization on their loan programs. Occasionally, we might see a shorter term, but recently, we're starting to discover longer amortization opportunities. For this reason, we're going to do a simple case study that evaluates a 15-year, a 30-year, and a 40-year amortized loan to see if the new 40-year amortization is something today's homebuyers might want to choose. In order to conduct a side-by-side analysis of 3 different loan amortization periods, we need to make some simple choices and assumptions to get it rolling. The purpose here is not to create a scientific experiment that conclusively identifies every aspect of the decision-making process. Rather, it's to show the impact that changing the amortization period will have on relevant issues to homebuyers today. Longtime viewers of our channel know that we provide charts, graphs, and analyses of housing market conditions as well as guidance for the decisions they will face. Today's analysis of mortgage amortization is a great example of what you will see on a regular basis if you also subscribe to our channel. All you have to do is hit the subscribe button below and give us a like while you're down there too. For many buyers, the amount of the monthly mortgage payment is the most important issue of all, so I'm going to start there. Afterward, we'll look at how the loan balances change over time, the rates at which equity growth occurs, and then we'll conclude with a simplified ROI analysis to provide some insight that many buyers would not consider. Finally, you should also consider the length of time you plan to own the home when making your choice. You don't need to lengthen or shorten the period of time just because you plan to move sooner or later, but you might want to ensure you choose a repayment plan that will have you in an equitable position prior to the date you believe you will be moving. Our example is built around somebody buying a $400,000 home with a 5% down payment of $20,000. This will result in a loan of $380,000 for which we'll evaluate 3 amortization choices, including a 15-year, a 30-year, and a 40-year amortization. In order to determine the rates to use for each loan, I went to the internet on November 12th, 2021 and determined the prevailing rates from reputable sources. I found the 15-year loan was 2.25%, the 30-year loan was 3%, and I estimated the 40-year loan to be 3.25%. These will work fine for our example, but you'll want to know the current rates the day you need to make a decision. Most likely, a borrower will be offered rates that are the lowest for the 15-year amortization and the highest for the 40-year amortization. If these rates were to draw closer together or further apart, it could have an impact on the decision a buyer will want to make. The principal and interest portion of the monthly payments are as follows. For the 15-year amortization, the payment works out to be $2,624 a month. For the 30-year amortization, the payment is $1,602 per month, while the 40-year amortization comes in at $1,360 per month. As we see from these payments, the longer the amortization period, the lower the monthly mortgage principal and interest payment. This makes perfect sense as a 40-year repayment stretches the principal requirement far longer than do the 30 and 15-year loans. It's interesting to see that the payment on the 40-year amortization is roughly 1/2 the amount of the 15-year amortization, and why it might be so popular with many buyers today. But as we follow with our analysis, we'll find that the lower payment does come with a price. Our first graph plots the loan balance over time for each amortization period. All three graphs in today's report run for the first 10 years of the loan's life. The horizontal axis looks a little confusing as it shows the year number every 2 months for every point in the graph. So, for example, you'll see 5 2s representing every other month of year 2 of the loan. The green lines provide the results for the 15-year loans. The blue lines provide the results for the 30-year loans, while the red lines show the same for the 40-year amortized loans. It is clear that a 15-year amortization period lowers the loan balance far faster than do the 30 and 40-year amortized loans. The extra $1,000 plus paid each month with the payment is the reason we see the results in this graph. If the payment amount does not scare you and you favor repaying the loan as soon as possible, the shortest amortization period is your best option. This graph has quite a few calculations occurring behind the scenes. It accounts for the down payment made when the home was purchased, the appreciation the home has gained each period, calculated at the home value increasing at 5% each year. It also includes the closing costs paid when the home is sold, estimated at 8% of the future home's value, as well as the principal reduction from each mortgage monthly payment. Similar to the first graph, the primary difference between the three results is the pace at which the borrower is repaying the loan. Again, we see the short amortization period resulting in more equity in the home because the borrower has put the equity in through the form of repaying the outstanding balance. The first two graphs have made it clear that if you want to owe less on your home and have as much real estate equity as possible, take on the shortest amortization period that you can handle. While this is attractive at first blush, I encourage you to take a global view of your economic situation when evaluating your repayment period. For example, if you owe money on your vehicle, wouldn't that extra $1,000 each month be wiser to apply to paying off your car than reducing the debt on your home? Or even better, if you owe money on a credit card, that extra $1,000 monthly could pay it off pretty quickly. So yes, less debt is better than more debt, but that debt on your home is against an appreciating asset, while most of any other debt you'll have will likely not be working for you. While people do not buy homes solely or primarily as investment vehicles, I like to encourage them to see the economic opportunity that a home provides. One way to do this, with our example, is to conduct a simplified ROI analysis for 3 different loan amortization periods. This graph was created by analyzing each month's equity versus the amount of money paid thus far by the borrower. I call this a simplified ROI because I have not accounted for the time value of money. Rather, I used a simpler formula of ROI equals equity minus investment divided by investment. Simply put, what did they put into it and what did they make? The investment includes their down payment as well as the principal and interest payments. Here are some observations from the graph. Take the results here more from a relational basis as opposed to an absolute one. I have not attempted to determine a fair and absolute ROI, rather I have attempted to compare the ROIs of each amortization period. It takes until year 4 for each of the 2 longer amortization loans to have positive equity, but it happens in year 3 for the shortest amortized loan. This means that the ROI is negative for a period of time before it turns positive, and it's negative longer for the longer-term loans. The ROI calculation does not include closing costs of buying the home, nor does it include the taxes and hazard insurance premiums being made. I have to mention these because these are real costs. Again, this is a relative comparison to analyze the impact of different amortization periods, and these costs would be fairly consistent. I have to mention these because they are real costs. Again, this is a relative comparison to analyze the impact of different amortization periods, and these costs would be fairly constant across each period. The 15-year amortization in our example delivers the best bang for the buck if you hold the home for 8 years or less. If you hold the home from 8 to 15 years, the 30-year amortization delivers the best ROI. But if you plan to own your home longer than 15 years, the 40-year amortization delivers the best ROI. And this is the point that I wanted to discover. You should consider your expected holding period when deciding on the amortization period for your loan. Equally as important, I'm advising home buyers that they will likely own this home far longer than similar buyers would have held it when we look over the past 50 years. Home affordability is going to tank, and in the future, it's likely that a major portion of would-be move-up buyers is going to have to stay put. That means the mortgage loans being borrowed today are likely to have much longer shelf lives than their counterparts from the previous 50 years. If you want to better understand this point, you should watch the video included above. Right now, mortgage interest rates are near historic lows, and many borrowers can leverage lower rates and longer terms to strengthen their financial positions. If you have debt on anything beyond your home mortgage most often is the last of all debt to satisfy, as it's likely the lowest after-tax rate that you pay. When it comes time to choose a mortgage amortization period, make sure you ask your lender for all the options for which you qualify. You'll want to know the rate and terms for each. If you would like to see more videos with answers to frequently asked questions from viewers just like you, I've assembled a great playlist that you can view by clicking on the box on the top left corner of your screen. To see my popular video featuring my 6 top home selling tips, just click on the box below it. Please remember to like this video, check out the links below it, and subscribe to our channel so that you never miss anything.